market goes down. Now, the question is, what do you do with your portfolio in those periods? Right? According to the Stock Market Almanac, in fact, what we ventured into right here, you see the purple line? This is where we're going right now. We're pulling back a little bit. Now, here's the good news. This is when we have all these sort of typical election seasons. One thing is that the green line, when you have a sitting president, you usually go down, and then we start to turn up, and then we take off like a rocket ship. There's a lot of theories for that. A lot of money pours into the economy when the incumbent's trying to stay in office, those kind of things. I want to bring in now Great Hill Capital Chairman Thomas Hayes. And Thomas, you're expecting some near-term weakness right now.
Yeah, that's right. And as you know, I've been coming on the show for a year and a half, bullish every single time.
Right.
So this is new for us. We actually put on a tactical short last week. We started on Tuesday. Then the market kind of crapped out after the CPI numbers, and we finished it on Thursday when the market recovered. So we have 1% of equity capital in near-term put spreads in case we get this 5 to 7%.
Is it to make
pullback.
money, or is it just as an insurance policy?
Dampen volatility. If we're right, we'll have extra capital to go long into year end. If we're wrong, it's 1% of equity capital. But the key is we don't have to sell out our positions that are not at full value so that we don't create taxable events.
All right, so, okay, I'm glad let's talk about that, because you actually wrote about why you hold into these dips, why
Correct.
you want to hold these positions, right? You want, and some of the things, if you own a quality business, then you stick with it, right?
Correct.
Stocks go up and down.
Yep.
If you believe in a business, you think it's a quality business, don't be so tethered to the share price on
That's
a day-to-day
right.
basis.
That's right.
Avoid a taxable event.
Yeah.
I've seen people do this and mess up. Like, in other words, they didn't want to pay, the tax, so they held a great win, and they ended up losing on the win anyway. Like, it would have been better. At what point, what percentage gain is okay to say, okay, I'll pay Uncle Sam a piece of this?
Yeah, so before we go into a company, we have an estimate of what's fair value, what's fully valued. So if they've not reached those events, we're going to hold through that short-term volatility, and we may hedge tactically just to dampen volatility and create excess capital.
But let's say you bought something at $30 and it's $50 now.
Yeah.
And it's starting to spin its wheels a little bit.
Yeah.
I mean, you've held it for 6 months or a year.
So here's what we did with Intel last year. We bought Intel at about $25.10. It went straight up to 48. We took off 2/3 of that because the legacy PC business and the data server business was fully valued, and we kept 1/3 of those profits on just on.
So the taxes had nothing to do with it then?
That's correct.
It was just all mostly
Fully
based
valued.
on the fundamentals being fully recognized in the share price.
That's right.
You see a strong year in rally. You've mentioned that. Also, earnings estimates are going up. Let's talk specifics now, because I like when you bring these specific names.
Yeah.
All right. This is my theory, okay?
Yeah.
Baxter, okay, we've got this trend line.
Yeah.
We're breaking through the trend line here.
Yeah.
Now, if I was doing this, if I was doing it, I would have something under the last low as my stop loss.
Yeah. Yeah.
Is that what you're doing? I know you like this fundamentally more than technically, though,
Yeah,
right?
so I came on December 12th with this name. It's up about 10% and change since then. The key thesis here is that the stock is trading at 12 times forward earnings. The reason it's trading is because growth has slowed down due to the kidney business. That's the slowest part of the business. They're spinning that out to shareholders before the summer, which means we could get a multiple re-rating, because what's left of the business is going to re-rate to its historic multiple, which is closer to 18 times.
Still, though, Canada Goose is another name. And, I mean, listen, it feels still like, okay, you like it fundamentally. You probably liked it fundamentally for a while.
No, we came on
just here recently.
Actually, in January, it's up 12%.
Is that when you liked it then?
That's correct. Yeah.
Breaking out, though, does that give you even more confidence, breaking this long-term trend line?
There's no question technicals play a factor, but the key is they crushed earnings and they increased their guidance. China was up 62% year on year. They love these luxury jackets. What they're doing is they're moving their business.
What happened then, because we got 30 seconds. What happened from here, though?
They had inventory problems, okay, major inventory problems. They over-inventoried with COVID, not dissimilar to Intel, by the way, not dissimilar to Baxter. All these companies, not dissimilar to Generac. They all over-inventoried due to COVID because they couldn't get product, then they got too much product, and they had to work that through over 6-7 quarters. These are now troughing, and you're seeing sales grow, margins grow, cash flow grow, and this business is going to recover nicely.
Great stuff.
Hey, thanks so much.
Oh, man, great seeing you. All right, coming up, my next guest says is trying to reverse 100 years of history, and he's doing it by helping low-income families. Damon Harris is going to join us with his story from West Richmond, Virginia, next. All right.